Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Real data last week showed that consumer and employment remains strong despite inflation, but there are some signs that spending is weakening. Joining me to discuss is Phil Mackintosh, chief economist at Nasdaq. Phil, it's great to see you as always. Welcome back to Trade Talks. And let's start with the good part of the data here.
Well, I guess the good part kind of depends on your view, right? So I know what you mean. You mean all the strong data, but the strong data's got some negative connotations because it's going to make it harder for the Fed to slow down on their rate hikes. But looking at the strong data, just in the last week, we've seen the services sector kind of bounce back and still be expansionary. So that's good news because the services sector is the biggest part of the economy. And so that's still going strong. If you look at the employment data, we're still adding jobs. There's still a lot of new employment going on. So that's positive. And if you look at some of the data behind that, there's still more jobs out there than there are people looking for work. So a lot of job security. And I along with the job security, the third chart here is looking at wage growth, and wages have been elevated, or wage growth has been elevated pretty much since we hit COVID, and it's stayed that way. So with all the job shortages, people getting paid more, which is good if there's inflation because it's helping them keep up, but it's also helping them keep spending. And that's your point why this is good data, because everyone's pretty secure in their jobs, they're earning more money and they're spending, which is good for the economy.
And then if we look on the flip side of that, though, while they're spending, they're not spending as much. They're starting to dial back a bit here.
Yeah, so there's other data, and it's probably data that the Fed's been looking at too, which if we look at the first chart on the left, shows the savings rate, which is the blue line there, is fallen way below pre-COVID levels. So with inflation, obviously people are spending more to buy the same amount of stuff. And it looks like, at least for some people, they're dipping into savings. They're stopping from saving and putting as much money into savings as they had been, especially during COVID. And so the blue area in that chart shows that all the money that people had socked away, whether it was stimmy checks or unemployment benefits, or just the fact that we weren't able to go on vacation, and so we were saving money that way, is starting to whittle down. And the long term is when it's gone, with the inflation, people are going to slow down their spending pretty quickly, which is not going to be great for companies. And the middle chart that we had there basically shows that the forward orders data for companies looks really quite weak. And so companies that think that they might have had pretty good earnings growth are probably not going to be able to sustain that into next year. And if we look at the last chart, the CEOs aren't very confident. So the blue line in that chart shows CEO confidence. It's at really low levels that typically are recessionary and also typically coincide with that red line going negative, and that red line is earnings. And so the one thing that the market hasn't priced in right now is the earnings contracting. So what we've basically got is the potential for a bit of a shock to the system if we have rates keep going up because of all the news we just talked about earlier, and earnings start to contract. And that's kind of the worst case scenario. But hopefully the Fed's looking at all of this as well, and they do slow down enough that the consumer can get us to muddle through and we have a soft landing. That's where we're at right now.
And we're seeing that, right? Whether you're talking about retail commentary or comments that are coming out of tech companies, that yes, some of these trends were accelerated, particularly when you think about online and the way we work in a hybrid environment and so forth. And yes, things might have been accelerated 3-5 years, but to think that these would be, everlasting trends when we kind of came back to normal, I mean, you had to expect in there that sales would shift from one segment to the other, or that inventories would need to be adjusted and so forth. And like we're hearing that now. So to your point, it'll be interesting to see, how analysts start to think about their ratings, their price targets, and their projections, and how these companies deliver. But Phil, it sounds like you have this conflicting data that the Fed has to deal with, and it just seems as if it makes their job so much harder.
Yep. That's 100% what we're talking about. And in reality, your point about the companies, they're kind of going through a similar thing, because we had a growth expansion, then it shifted with the vaccines to the services sector, and people have been hired into different jobs, and there's a shortage of labor. And so it's been really difficult for companies to manage through this as well. And that's potentially part of the CEO confidence problem, is that they're just really having trouble managing inventory levels with demand shifting from one thing to the other as well. So it's a tough environment to make good decisions going into next year. A lot of the people that are sort of forecasting what's going to happen to economic growth are still thinking we may have a recession, but not a deep one. And so that's probably a good outcome.
All right. Appreciate the insight as always, Phil. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.